Welcome to Chapter 2 in Accounting. What we're going to begin to look at this week is something that's really going to form the basis of your accounting studies from here on out, not just this semester, but in your future accounting courses to come. And I'm going to spend a fair amount of time on it and try and break it down into fairly simplistic parts because I really want to make sure that this makes sense before we move beyond this. And I have students, some of you are right out of high school, some of you are still in high school, others of you have had decades in the working world. And for those of you who have had decades in the working world, these terms may be familiar and you may have a context to put these concepts into, whereas students who have not had a lot of background in business and industry, this is going to seem like a foreign language. And if it does, don't be scared. It will hopefully start to gel the more time that we spend on this. So if it seems like I'm making this too simplistic, I apologize, but I really want to make sure that everyone understands these concepts. And because I remember when I was in your shoes as a brand new accounting student, and I was right out of high school, this was all completely foreign to me, and none of it made sense, and it just got harder the less I understood it and the class went on. So I'm going to try and avoid that experience for all of you. And so what we're going to begin to look at is the elements of the accounting equation. And the first element we're going to talk about is assets. A business is going to own assets, we hope. And assets are defined as something that's going to provide a future benefit. Assets must be owned by the business and not rented. Now, sometimes, and I have clients come in and I ask them about what they own, and they say they don't own anything, the bank owns it. And that's a real fundamental mistake when looking at assets. Just because somebody owes money on something, and it may be they may have had to borrow the full purchase price of the item, doesn't mean the business or the individual doesn't actually own the item. So there can be money owed on an item, but it is still an asset as long as it's owned by the business. Some examples are cash, merchandise, fixtures, furniture, machinery, buildings, land, accounts receivable. And if some of these aren't clear, again, we'll go over this a little bit more. And so if, hopefully every business is going to have cash. Hopefully it'll be more than $4, but cash is an asset. Similarly, bank accounts are an asset. If I'm, in carpentry, this is an asset for me. This is going to provide me with future benefit. I'm going to use this to go out and make money with. Let's see. If I'm a plumber, yes, I had to walk around and collect this around my house. This is an asset. This is something I'm going to use to provide future benefit. This computer that I am recording this video on is an asset. It's something that I use in business and will provide me with a future benefit. My car that I use to drive to court, not the car that I drive back and forth to my teaching job, but as a business person, it is a business asset. If I was a painter, anybody, I could be a factory worker. I could own a factory and have machinery and supplies and things like that. Those are all assets. Those are things that we're going to use in our business that will hopefully provide us with a future economic benefit. Accounts receivable is something that may be a new term, and so when somebody comes in and buys something from us, we're the business. We're selling a product, we're selling a service, and they may not necessarily have the money to, here I'm going to buy something from you and give you cash. They may have to put it on account. I was down at the building supply place this morning buying some things, and the contractor in front of me said, "Can you put this on my account?" I don't have an account at the building supply place, but anyway, for the building supply place, that contractor's account is what's known as an accounts receivable. And so it is money that customers owe to the business that they will pay at a later point. Their credit account, restaurant could have it, somebody could have a tab. All of those are accounts receivable. When I send bills out to my clients at the end of the month, my list of clients who still owe me money is my accounts receivable. An accounts receivable is an asset. Now we're going to move away from assets to the next factor in our accounting equation, which is liability. Liabilities is something that we as the business owe. And it is going to, it is our debts, it is our obligations. So examples of that would be accounts payable and notes payable. Now you may say to yourself, well, what are those? Think of accounts payable as kind of the flip side of accounts receivable. So that builder who was standing in front of me in line at the building supply place put something on an account with the building supply company. For the building supply company, that is an accounts receivable. For the builder, that's a debt. That for him is an accounts payable. So it's the same transaction. On one side, we have the receivable. On the other side, it's a payable. So the person who owes it, that's an accounts payable. The person who it's owed to, it's accounts receivable. Then we have something called notes payable. Notes payable tend to be longer term obligations. An accounts payable may be something that's due in 30 days. It's a pretty quick turnaround. Whereas notes payable, we're looking at things like, car loans, loans on factories, long term, where you've got an ongoing payment stream. You might have monthly payments, whereas an accounts payable is probably going to be due in full in a certain amount of time, as opposed to having monthly payments where there's interest rates and things like that. Now, your book describes an accounts payable as an unwritten promise to pay a supplier. Even if it's in writing, you can have payment terms in an accounts payable. So I don't necessarily agree with your book's term as it being an unwritten promise to pay a supplier, because I am sure that the contractor that was in front of me had to establish an account in writing and create an agreement, and that before he walked out of there with the items, he had to sign a slip agreeing to pay it according to the terms of his account with the company. But as this slide says, and this point's very well taken, be really careful not to confuse the terms accounts payable and accounts receivable. What that is depends on which side of that transaction you happen to be standing on. So again, for the building supply store, that transaction was an accounts receivable. They're going to receive it. For the builder who's going to have to pay that obligation, it is an accounts payable. So when you're looking at the transaction, as your slide says, ask yourself, am I going to be paying money or receiving money? And that's going to determine whether it's an accounts payable or an accounts receivable. An accounts payable, remember, is the liability. An accounts receivable is an asset. And, notes payable, again, this just reiterates, we're going to have defined future payment terms, monthly interest rates, things like that. Now we get to a concept called owner's equity. And it's also referred to as net worth or capital, but most commonly equity. And this is a particularly important concept because equity is the amount by which the assets exceed the business liabilities. Now, what? What does that mean? So if we break it down into pretty simplistic terms, I have all these assets here. What else do I got? Oh, I got a painter, I got a paintbrush, I got. So I got quite a business going here. I got all my assets. Now, I had to borrow money in my business. These are getting heavy. So if I sold all of my tools here and paid off all my business debt, otherwise known as my liabilities, how much money would I have left after I sold the assets, used the money, paid off all the debts? Hopefully, I got some money left over. That money I have left over is my equity in this business. Now, I don't have to actually sell anything and pay off anything. The equity is kind of this theoretical concept of what is my company worth to me? What is my equity in the company? And it is the difference between my assets and my liabilities. So again, if I used my assets to try and wipe out all of my debt, how much money would be left for me in terms of equity? And that's my value. That's what the business value is to me. And I'm going to just skip this over. And so I'm going to actually stop this video here, and we'll move on to the next video where we look at the concepts of assets, liability, and equity and use those to construct the accounting equation.